This is the most challenging part of the entire 2 days though. And here's why. We're going to ask you to start thinking like business owners. Because we're going to start talking about commercial policies now. Now, a lot of what commercial owners, business owners have to deal with is kind of similar to what we had to think about as private citizens, right? As far as how do we protect our property and how do we protect ourselves from being sued, okay? So property and liability coverages, only now we're kind of thinking on a different kind of scale, okay? So there's two different types of policies that we're going to be talking about for the next couple hours, but they can both be defined by one two-word phrase, and you need to know it. These are called business or commercial lines. Okay, so if you see anything about commercial lines or business lines or anything like that, remember how I said everything we talked about yesterday was personal lines? So this is commercial lines. The test you take, word for word, is called the Property, Casualty, and Allied Lines test. So this is where we get these words, this lines, okay? So commercial lines policies. There's two of them that we're going to break down, though, in some detail. The first one is called the BOP, the Business Owner's Policy. Right, so if you see the word BOP, right, it's not talking about a dance, it's talking about a policy. BOP, B-O-P, Business Owner's Policy. Now, most small and medium-sized businesses would prefer to have a business owner's policy. And the reason why is because everything's pretty much done for you the exact same way it was done for us in homeowners yesterday, right? You had your property, you had your liability, and all you had to do is kind of fill in some small blanks. But guys, sometimes businesses can't get business owners policies for one reason or the other. They don't satisfy all the requirements, or they have too many liability concerns, and they can't get a business owner's policy. And so what they're going to have to do is they're going to have to get a CPP, and what this stands for is Commercial Package Policy. One of the biggest differences, though, between the BOP and the CPP is that the BOP, everything's done for you. The CPP is designed completely from scratch. You start with nothing, and you build that sucker from the ground up. Okay? A lot of your large businesses have CPPs, even some of your small and medium-sized ones do as well. Right? So those are the two policies that we're going to be breaking down. Now, before I go much further, I need to kind of give you a little quick, some of the characteristics about what a BOP is, a business owner's policy. Right? I said they're designed for small and medium-sized businesses. All right, but what you need to understand is it's a package policy that's very, very similar to the homeowner's policy. And I will say this, the last time I took this test, one of the questions they gave me was the business owner's policy is most similar to which of these other policies? And I can't tell you what the other three answers were, but the right answer was homeowners. Right? A business owner's policy is very, very similar to homeowners. Why? Because you got your property, you got your liability, and there's not many things you can change here. Right? Everything's kind of done for you. And I've got another good piece of information for you when it comes to protecting your property underneath a business owner's policy. You only have one choice to choose from, and that is the special form. There is no basic, there is no broad, it's always going to be special. Okay? Remember what special is. It means it's going to cover every peril. It's going to cover from anything happening to it as long as it didn't happen as a result of a named what? Exclusion. Okay? Named exclusion policy is what that special form is. Also need to talk about how you become eligible for one of these things. We'll get into the detail of it here in just a second. But we got to talk about how you become eligible. Are you an apartment building? Are you an office building? Are you a retail building? Right? Just small little stores, small little mom and pop shops. They get business owners policies all the time. Selected processing and service occupancies. That's what we are. We are a service occupancy. I am serving you by giving you this class. Right? So we have a business owner's policy. Doctors' offices have business owners policies. Right? Almost any kind of small business you can think of, really, is going to be able to get one, unless you fall into some of these categories here. So is it important to know who can get one? Not necessarily. It's more important for you to know who can't. Okay? The first class of businesses that can't get business owners policies is any type of business that's a bar, a grill, or a restaurant. And the reason why is because you're dealing with both food and alcohol products. And anytime you're dealing with food in general or alcohol products, you're talking about major liability concerns there, okay? Liability concerns that can't be matched by business owners' policies, okay? Condo associations, other than office or residential, contractors, if you're a general contractor, you cannot get business owners' policies. If I'm a place of amusement, such as a fair, carnival, or a bowling alley, or a movie theater, I mean, you think about the sheer scope of the number of people coming in and off your property every single day, let alone every single year. There's way too many liability concerns there for you to just get one of these generic business owners policies, okay? Wholesalers, financial institutions, any business that deals with money, right? Banks can't get business owners policies. And auto dealerships, auto repair shops, and automobile service shops cannot get one of these policies, even if they wanted to. They're going to have to go with the CPP and divide and actually build that policy from the ground up. Okay? Yes, sir?
All of these go for the CPP then, or?
Yeah, pretty much. For test purposes, when you get into commercial lines, bud, I'm telling you, it gets majorly complicated. But the test, thank goodness, doesn't get complicated, right? It has to keep it very simple because this is the same commercial lines policy that they're going to test on in California, in Hawaii, and Maine. Okay, so that's why we got to just be very, very simplistic in general about this. If you ever sell commercial insurance, it may very well not look anything like this. Yes?
So we talked about our homeowners and running a small business out of it.
Correct.
This would not be, you wouldn't get business owners. You would get business owners.
The
For
business,
the
if that business,
31
if that business that you're running out of your home,
Uh-huh.
if you can't get homeowners because you have maybe more than 2 employees or you're actually holding on to a bulk load of product or anything like that, this is how you would have to cover your home now.
Okay.
Why? Because it's going to give you a way to cover your building, which of course in that case would be your home, and then of course your property. But we'll break that down here in just a second. That's a great question though, Diane. Yep. Okay, also need to know who isn't insured. Now this is true, guys, of both the CPP and the BOP, so please put that above here. We're talking about commercial lines policies here. Who isn't insured? Well, it's the named insured is obviously the people who own the business, right? It's the sole proprietorships, that would be the sole proprietor themselves and their spouse. If it's a partnership, then it would be each partner and their spouse. If it's a board of directors, it could, every single person of that board could be considered a named insured. However, they are probably going to have to elect one person to still be the go-between, right? The one that's still going to have most interaction between the company. But all of them would have some kind of say in how that policy is handled. But who is the other insured? So the named insureds, that's kind of easy. But who are the other insureds? Quite simply, guys, it's your employees. The people who work for you. Okay? And your employees in the scope of doing their business, right? In the scope of doing their work. Of course, if they're injured on the job, right? If they get hurt, then of course they're not talking about being covered under a business owner's or a commercial package. You're talking about them being covered underneath what? Workers' comp. Yeah, of course. But what about if your employee hurts somebody while that person is on property, right?
Liability.
Then that's going to be covered underneath liability concerns that we're going to break down here in just a second, right? So, of course, other insureds are employees, legal representatives in the case of death, right? That was the death provision from yesterday, and any other person using mobile equipment with permission, right? Because, of course, if you gave them permission to drive it, then, of course, they're acting as a representative of your business. Okay, before we go over this, I want to hit on the details of how the coverage breaks down. So let's go ahead and start with your property coverage. So it divides it into 2 sections, very similar to your homeowners, right? Property and liability. And your property is divided up only this time into 2 letters, and that's all you need to remember. Letter A is very similar to yesterday. It's your building, right? This is where you're operating your business out of, okay? And we said yesterday, anytime you are insuring your building, anytime you're insuring your home, anytime you're insuring any type of concrete structure that's not a concrete or a fence or anything like that, then you're going to insure it with what kind of value?
Replacement.
RCV, yeah. Replacement cost value. And of course, the inflation guard would be very, very helpful here as well. Why? Because if commercial property goes up in value and all you're doing is maintaining 80%, you never want to be underinsured.
Right.
Right? Because that's what the inflation guard was going to do, right? It was going to allow you to keep up to date with inflation. If your property values went up, what would automatically go up as well? Your limit. Right? Your limit would go up to make sure that you would not be underinsured. All right, so that's your building coverage. We already know what that is. The next one is a term that we used very, very quickly yesterday, but we're going to talk about it a ton today. In fact, you're probably going to be sick of me saying this by the end of the day. I don't care. It's business personal property. This is how you protect the business's property. How do you define business personal property? You're sitting on it. You're using it. I'm using it.
Why is it called?
It's any item that you use to run your business. So these tables, these chairs, these books, this projector, this computer, this screen, these are all considered business personal property, okay? It's personal property of the business. The business owns it, and they are using this property to run their business. That's the best way to describe it. Is it inventory? Yes. Is it this? Yes. This is an inventory, but it's still considered business personal property, right? It's any item that you are using to run your business is defined as business personal property, okay? Now, I need to be very clear about something. Underneath this coverage right here, underneath your business owner's policy, in order for it to be considered business personal property, you actually have to make sure that it's within 100 feet of your business premises. See, if you have personal property of the business that's outside of 100 feet, that's not necessarily going to be covered here anymore. It's not technically business personal property at that point. It has to be within 100 feet of your business premises. And we're going to hit on this concept again here in just another page or two, but I wanted to introduce that. But I want you to also think about this. Other things that you need to include with business personal property, of course, inventory, right? We already talked about inventory. Now, in how they're going to base your rates off of this policy are going to be based off of what you own, right? What do you keep in inventory? What do you want to insure for losses against? And there are some companies that have inventories that fluctuate over the year, right? Mm-hmm. I mean, one of the biggest businesses that this affects just happened, last week with florists and Valentine's Day. Right, over Valentine's Day, what did they have? They probably had like 20 or 25% more inventory on hand than they normally do any other time of the year. But what we're allowing them to do is have that without being charged anything more. It's called peak season coverage. Why? Because we don't want them to be penalized for the fact that they need to carry on more inventory during this specific part of the year just to maintain demand. So we're going to allow them to do that. If they need to carry on anything more than that, they may have to pay a little bit more in premium. But once again, more often than not, people don't need more than 25% more than what they normally carry. Okay? So that's peak season coverage. Yes?
You're going to answer this, I know, later. But okay, so the florist has extra amount of inventory. What if it's more than 100 feet off of their premises? What if it's in another warehouse down the road?
We'll talk about it.
Okay.
Yep. Hold on to your question. I know where you're going with that. Okay. I promise we'll come back to it. All right, the next term you need to know is this term right here, business income coverage. And yes, I have seen plenty of questions on these exams when I've taken them before dealing with this term, business income. And in order to understand what business income is, guys, I want you to flip over to the bottom of the next page. And we're looking down here in the definitions box down here because it's the only place we have room for it. I want you to know what business income coverage is. Business income coverage is insurance that provides income to a business to cover things like salaries, to cover things like payroll, to cover things like other expenses that will continue during a business interruption. What does this basically mean? Your business is shut down because of a covered peril. Not period, right? I mean, if you shut down because you're bankrupt, that's not what we're talking about. We're saying you're shut down because a storm or a covered peril has damaged your building or damaged your business to the point where you can't operate anymore. If you don't have income coming in anymore, how are you supposed to pay your salaries? How are you supposed to pay your payroll? How are you supposed to pay your rent? You can't, right? I mean, you are handicapped to the point now where you can't even pay those expenses. So this coverage right here, the business income coverage, will replace the income you don't have coming in anymore. Okay? So this is replacement insurance. Do me a favor and write in that word, replacement insurance, right there. Because that's what it is. It's going to replace income that you don't have coming in anymore. That's what business income coverage is. Now, along with business income, you need to know this term as well. It's called the period of restoration. Period of restoration is the time frame during which the business income will apply. Okay, so this is the time frame during which they're going to pay out that benefit, beginning primarily after a direct covered loss, and then ending once the building is either repaired, replaced, or rebuilt.
What you just said.
What's that?
My book doesn't have that.
Your book doesn't have that? The period of restoration?
I only have 3.
No, she
How in
doesn't
the
have
world
it.
is? Oh,
No, I just noticed that back in over here too, but can I get an extra book?
that's weird.
Here.
Yeah, I'd have to,
Oop, sorry.
I don't know how you got an old book. I apologize for that. Okay, so that's the period of restoration. Now, let's jump back over to this page real quick. I'm just going to review what business income coverage is underneath your business owner's policy. It's an unlimited dollar amount that would expire at the expected business continuation date, but no more than 12 months. So your period of restoration can't be anything more than a year here, is what we're trying to say. Right? It can't be anything more than a year, and the reason why is because if you can't get your business back up and going in a year, chances are you're never going to get up and going again anyway. And the insurance company's like, we're not going to continue to funnel money into this business if it's not going to get back up and going again anyway. Okay? So, once again, if you hear the words business income, what's the one word you think of? What's the word? Replacement. Okay? It's replacement insurance. But let me kind of throw out a hypothetical situation. Norris Training Systems. I operate out of this building right here. Do I own this building?
No.
No. But if this building is completely destroyed by a covered peril, right? If this building is totally destroyed, am I in a position where Norris Training Systems would actually be shut down?
Yeah, sure. Oh, because,
I can move this business anywhere I darn well want. Can I? There's no reason why I should ever be shut down. Right? I already told you, I move this business to Topeka twice a month anyway.
yeah.
What's saying that I can't move it somewhere else, right? We are a business that can relocate somewhere else. But let me ask you this. If this building is totally destroyed by a covered peril and I have to relocate, am I going to have to find a new building? Yeah.
Yes.
Will I have to pay rent to that building?
Yes.
Am I going to have to buy some more projectors?
Yes.
New computer?
Yes.
New books? Print new books? Yeah. Right? There's going to be some things that are going to happen here. There's going to be extra expenses that I'm going to incur as the result of having to relocate. But why would I rather have that happen? Because I'm trying to prevent this from happening. I'm trying to prevent from being shut down. And so what I'm hoping to do is continue my business at a different location. But if I do, I want to be able to be compensated for that. And that's what we call extra expense insurance. So you see that definition down there, extra expense insurance. What does it do? It indemnifies the insured. What does it mean to be indemnified? Reimbursed. Made whole again, right? If I am being reimbursed, I'm being indemnified for, what am I being indemnified for? Expenses that are incurred when the business temporarily relocates to another location to prevent loss of income because the building has been damaged by a covered peril. So it's going to cover rent, it's going to cover cost to recreate documents, books, equipment rental, etc. So if business income was replacement insurance, what do you think we call extra expense insurance? Relocation. It's relocation insurance. If you're going to relocate to another place, extra expense will cover those costs that it's going to take for you to relocate. Why? Because once again, guys, you want this to pay out, so this doesn't have to. Because remember, if you are shut down, then you're going to need business income. But you're trying to get those extra expenses covered. That way, you don't have to even come close to this. If I can keep my business going at a different location, who cares? Income's still coming in. I can still pay my rent to my old building. I can still pay my salaries. I can still pay my payroll. I can still do all of that. Okay. All right. So that's what extra expense insurance is. Once again, relocation. That's what it is, relocation expenses. Other property that can be covered by your business owner's policy, outdoor signage, do you have any? Can be covered up to $1,000. Maybe that's good, maybe it's bad, just depending on what kind of signs you have. Bailey's coverage, could also be added in here, right? That's a property coverage, but we're gonna talk about that underneath inland marine. Employee dishonesty. If I wanna buy one of those fidelity bonds, that's something I can add in here, right? We talked about those at the beginning, or at the end of chapter 3. Money and securities. That's a big one, right? We said financial institutions can't insure themselves under BOPs, and this is why. Because other small businesses can protect their money, can protect their securities, can protect those things that they have on hand. That's why you can't have business owners policies if you're a bank, because of the sheer amount of money you keep on hand, right? But if I'm just a small retail store, can I protect my money from losses? Of course I can. I can add that on. Okay? I can be covered for any kind of theft, really, burglary, robbery, or theft. And we're going to look at those kind of different definitions here at the back of the book here in just a little bit. This is another one right here. Boiler, pressure vessels, and air conditioner. This is called mechanical breakdown coverage. But Andrew, I thought you said I couldn't cover mechanical breakdown. I did if you're under talk about personal lines coverage. But guys, under commercial lines policies, if, let's say, and there's a boiler right outside that keeps this building heated in the middle of the winter. If that boiler goes down, could that affect how all 60 of the clients of my property manager view his business? Of course it could. That's a massive financial loss possibly to that business. So what are they going to do? They can actually insure that underneath mechanical breakdown. All right. So you need to know that. That can be covered underneath commercial lines as well, and additional outdoor signage if that's not enough. So these are ways to cover your property, the business's property. But the liability concerns when it comes to a business are much more vast, much more broad. And we're going to talk about these in detail here in a few pages. I don't want you to think that I'm skipping over this page, because I'm not. Or skipping over this section, because I'm not. What I am doing, though, is I'm telling you right now, there's a reason that I want to come back to this square. Okay? This square is actually one of the last few things we're going to talk about today. But what I want to talk about now is this little box right down here. If the building is vacant for over 60 days, everyone know where this is going? Yeah, we've seen this already, right? If the building is vacant over 60 days, then there's no coverage for, oh, there it is, theft, vandalism, oh, and this time they're going to throw in sprinkler leakage. Okay, so there's 3 perils now underneath commercial lines policies, that if your property is vacant for over 60 days, they won't cover for losses caused by vandalism, theft, or sprinkler leakage. All other losses are actually reduced as well by 15%. So they'll cover them, only they're going to take 15% right off the top. Why? Because you kept your property vacant. That's why when property managers have property that's vacant for a while, they get a little concerned, because so does their insurance company. Okay, they got to find a way to keep it at least occupied, right? Doesn't have to be, doesn't have to have people in it, but it does have to have, contents, boxes, furniture, you name it. Okay. All right. Now, also 10 days notice for non-payment of premium. Does that look familiar? Same thing as it always has been. 30 days notice for any other reason if they want to cancel you out. Right? They've got to give you 30 days notice. These are some of the reasons, though, why they can. This is a lot different from some of the other stuff we've looked at, but remember, we're business owners now. So 30 days notice for permanent repairs who haven't been started or contracted after payment of a claim. See, if the insurance company paid you out a claim and you didn't actually get the work done that claim was supposed to cover, what will the insurance company think? Possibly pocketed that money,
Yeah.
right? Either that or you needed it to run your business, like you're in really big financial trouble. So yeah, of course, if something like that happens, they're gonna be like, oh, maybe we don't want to be a part of this anymore. Outstanding order to vacate, to demolish, or declared unsafe. Fixed and salvageable items are being removed from the property. What does fixed means? That means property that shouldn't be removed is, right? Items that shouldn't be removed are. What might that tell the insurance company? You're planning on skipping town sometime soon? Or that you might even be thinking about setting that building on fire, right? Because you're trying to salvage any items that you can before you actually light the match. Crazier things have happened, guys. People pulling over at insurance companies all the time. That's why they're going to use that as a way to cancel you out. Not furnishing heat or electricity to that property or water for 30 days could be another reason why they're going to cancel you out. And not paying your property taxes for more than a year. Now, up until this point, everything we looked at yesterday, all personal lines coverages, your homeowners, dwelling, farm owners, mobile home, everything we looked at yesterday, and everything we've looked at up until this point, your personal auto and your commercial auto policies. If the insurance company wanted to cancel you out, they could do so for any reason within how many days? 60 days. And if they wanted to non-renew you, how many days notice would they have to give you? 30. That hasn't changed yet, right? That's true of everything we've looked at up until now. Commercial lines policies are a little bit different. And that's why I want to make sure we remember the differences here, right? We drew that line so we know when it's 60 and 30 over here. But guys, for your commercial lines policies, for business owners and commercial package policies, your insurance company can cancel you out for any reason within how many days? 90. It went up by 30 days.
And
So if you're,
non-renewals, how long?
what's that?
Non-renewals, how long?
I was just about to go to that.
Okay.
Yeah. Right, but this goes up by 30 days. So if you're a number person and all you need is some kind of association here, it just went up by 30. That's all it did. Okay? But if they want to non-renew you out of a business owner's policy or a commercial package policy, how many days notice do they have to give you now? 60 days. That went up by 30 as well. So it didn't change drastically, but it did change. And you do need to know both of these guys. You just have to. That cancellation now, they can cancel you for any reason within 90 days, and if they're going to non-renew you, they have to give you 60 days notice before they do so. Okay? Any questions on that? All right. A lot of information on that first page here. As we're breaking down this page here, this is dealing once again with the word conditions. Another word that we use to describe a condition is a what? Provision, right? Conditions and provisions are the exact same thing. Remember what I said, the context doesn't change, but the application does. So whenever you see these provisions now being used, you've got to think about in commercial policy mindset. You're a business owner now, not a homeowner, but you're a business owner. Think about how some of these might work. Cancellation and non-renewal, we already hit on that. We already know what those time frames are. Changes, policy terms can only be changed by the insurance company in writing via an endorsement. We already knew that, right? Any change that you make has to be done in writing. Concealment, misrepresentation, or fraud, if committed by an insured, it could void the policy. Absolutely it could. It's not true just only of business policies, but of course that's true here. Insurance under 2 or more coverages. Insured can collect from all coverages under this policy up to the amount of the loss, right? So that means, once again, you have more than one policy, which is kind of what other insurance is talking about. You can have both of them pay out, only up to the amount of the loss though, right? None of them can pay over that. Liberalization, revisions that broaden the coverage, make it better. Can they do that? Absolutely. They're automatic, as long as they don't mess with your premium. Okay? All of these hopefully should look familiar. I mean, we've already kind of beat some of these to death. Premiums, the first named insured is responsible for all premiums and receives all refunds. Why? Because remember, that's the person who has all interaction with the insurance company. The premium audit. In a business owner's policy, remember what I said, your premium is based off of, it's based off of your business personal property, right? And of course your building if you have one, but if you don't have one, then it's just based solely off of your property. If you underreport, right? If you say you have all of this property, but now you actually they come to you at the end of the year and they're like, oh man, we had all this new property that we had to buy. We had to buy, a new computer for our new salesman and all this kind of stuff. And they're like, oh, you did? Did you let us know about it? Because if we didn't, what are they going to do? They're going to charge you the difference, right? The same way they've done all day, guys. That's why I told you it's really important that you understand the audit process, because we don't only see it in workers' comp, we don't only see it in business auto, we also see it in commercial as well, okay? But it's the same process, it's the same idea. Subrogation, transfer of rights of recovery, right? Your right to sue against others to us, they have the right to do that, to require that, Assignment, cannot transfer without written consent of the insurance company, except for death of the named insured, which we said becomes the legal representative. All of these, guys, we've already seen. Hopefully, nothing here is new information. It really shouldn't be at this point. Other things that shouldn't be new information are specific conditions and provisions to property and liability insurance. Right? I could use this as another review, but frankly, we've already did this right before lunch. Okay? Appraisal, we know what that is. Duties in the event of loss or damage, we know what those are. Legal action against us, we know when we can file legal action against the insurance company, of course, when we've complied with all policy provisions. Loss payment, we haven't talked about this one yet today, we talked about it a lot yesterday though. and that's who the loss gets paid out to. And a business owner's policy and a BOP, where do you think the loss gets paid out to? The business owner. Yeah. Right, of course, gets paid out to the business. Recovered property, same idea. The business has any items that get stolen from them. Do they have the right to recover them if they're found? Of course they do. Well, what do they have to pay back? The claim check, right? They can't keep both. Other general conditions, if there's a mortgage on the property, remember the mortgagee has just as much insurable interest as does the insured, right? That's not anything new. Policy period, what has to happen during the policy period? The loss. And the last one here, this is one that we haven't talked about yet, or we did talk about, excuse me, but here's the provision now that tells us so. So coverage territory. Where should I be covered? Where does the loss have to take place for property claims to be covered under my business owner's policy? It had to have taken place in the United States, its possessions, Puerto Rico, Canada, provided, this is the key part, and you should have wrote this down already, but if you haven't, underline it, provided your business personal property is within how many feet? 100 feet of the business premises. Is there a way to insure our property outside of 100 feet? There is, and we're going to talk about it as soon as we get back from our next break. Okay? But in order for it to be covered under business personal property, it has to be within 100 feet. The liability conditions. Bankruptcy. Does bankruptcy ever keep an insurance company from paying out a claim, even if the business goes bankrupt now?
No.
All that matters is the policy's in force. Right. Duties in the event of occurrence, claim, or lawsuit. We know what we're supposed to do. If someone wants to file a lawsuit against us, what do? We cooperate fully, but we never, ever, ever admit what? Fault or guilt. Right? We don't make payments or assume any obligation there. Legal action, of course, we know when we can do that, and we can do it within 5 years. And coverage territory is the United States, its territories, possessions, Puerto Rico, Canada, international waters and airspace between the coverage territory. That's where a liability claim would have had to have happened in order to be covered. All right, so what we just kind of went over here, I know we just kind of blew through this section, but honestly, if any of this is looking unfamiliar, I would really direct you back to page, I believe it's like 1.3, 1.4, going, or actually 1.4, 1.5, that went through all of the provisions, right? I mean, where we outlined every single one of these in absolute detail, okay? Was the business owner's policy, right? That was part one of our commercial lines coverages that we're going to talk about. And of course, almost every small and mid-sized business that you could think of would want to be a part of this if they could. Why? Because everything was done for you. But if they can't take part in this, then they do have to have insurance. Obviously, that's not really a choice. I mean, of course, if they're trying to be financially savvy. So they have to build a policy from the ground up, and that is the CPP, Commercial Package Policy. So do me a favor and write in the phrase designed from scratch right up there. Because it is. It's designed completely from scratch. There is no template, really. Right? This isn't one thing where you're just kind of filling in some blanks. This is, you're designing it from the ground up. Now, there is a general idea for how it has to be built, though, and it has these 4 parts to it. You've got your deck page, right, which is what, of course, is the deck page. That's everything that's going to be specific to this contract, like your company's name, their address, policy period, the producer that sold it to you, described premises, mortgage holder, description of the business, premium for each coverage part, which we'll go over the coverage parts here in a second, and then the total premium and due date. Common policy conditions. Where are they going to pull most of these from? They're going to pull them pretty much from this list right here. Okay, pretty much the same conditions, provisions that you've been dealing with. However, there are a few of them that are kind of addressed here we haven't really talked about, like examination of books and records, and inspections and surveys. Why? Because the insurance company might need to come on site to determine, are you properly reporting everything, right? Are we insuring everything we should be, or are you under-reporting things as a way to try and save money on premium? And so we have to give them the right to come on our site and examine our books, examine our records, just to make sure that we're being 100% upwards and honest with them. And then any endorsements as needed, as you might need to add them on. But the commercial package policy, guys, is made up of 4 major parts, right? So it's almost like these are 4 mini chapters. All right, so that's how I kind of want to break this down, because if I kind of approach this all in one, you're probably going to be like, what? So let's just break it down each by one section. We're going to focus in on this section first. Why? Because we've talked about this section pretty much all day over the last couple days. All right, and it's called commercial property form. This is how the business, when they design this policy from scratch, determines how they're going to insure their property. Okay. Now, if they're building this from the ground up though, they have the choice of choosing if they want to use the basic, broad, or special coverage. Remember, underneath the business owners, they didn't have that. They had to have the special, right? But underneath this, you get to choose how you cover your property. Are you going to use basic name perils? Are you going to use broad name perils? Or are you going to name it a special form where it's just not going to, it doesn't matter what perils are covered, only as it doesn't happen as a result of a named exclusion, okay? And then, of course, you have to decide, what am I going to cover? Am I going to cover just my building? Do I not have any business personal property? Highly unlikely. But if you don't need to insure a building, though, then you don't need to, right? You're going to have the option to endorse that off. You don't even need it. But you do need to decide how you're going to cover your business personal property. And we talked about a couple ways you're going to do that with business income coverage, right? These are options, guys. These aren't requirements, right? You're going to build this. You're going to tailor it to meet your needs. So if I want business income, this is what I'll choose. But if I need extra expense, that's what I'll choose as well. Now, if I need extra expense, maybe I don't need business income. Maybe I can endorse that off. There's no great way my business will be shut down. So I can take that off to make sure I can save myself some premium here. But there is one item of property coverage we haven't addressed yet, and it's called builder's risk. What builder's risk coverage is, guys, is it's coverage for general contractors or building contractors, okay? It's construction companies who are wanting to cover buildings while they are being constructed, right? Because once they're done, that's building coverage, right? But builder's risk coverage, which is right here, physical coverage, is going to cover contractors while the building is in the course of being constructed. Because if it gets damaged before it's even done, that's not covered under building coverage, guys. No one's in it. No one's operating out of it yet. So you need builder's risk in order to cover that. And you might see a test question over that, so you want to make sure you know what that is. Okay? But almost every single item that we've talked about, or every single item that's in this box, we have talked about recently too. Okay? So this is the generic way of how the insurance or the business wants to cover its property. But do businesses own just property that can fit within 100 feet of their business premises?
No.
No. I mean, businesses, entities, organizations, they can insure, or they can own property that's well outside of 100 feet, right? I mean, you talk about cities. What do cities own? Cities own bridges. They own tunnels. They own docks, right? You're talking about massive TV corporations. What do they own? They own these massive satellites, right? They own all of these things that can't be really insured underneath this nice cookie cutter definition of business personal property, right? But we have to have a way of insuring them, don't we? All right, we got to find a way of insuring these big pieces of property. Remember, construction equipment, right? Mobile equipment like bulldozers, backhoes, cranes, all of those things you can't insure as business personal property, right? And any item that's in the process of being moved from one location to the other, you can't insure that under business personal property. You can't insure that under commercial auto. You can't even insure that underneath your business liability if something happens to it. What do you have to do? You have to buy a generic type of property coverage called inland marine. Inland marine coverage, guys, is a property coverage, okay? It is a property coverage. It's designed to meet the needs that business personal property can't. Okay? So the use of inland marine is restricted because the insurance department doesn't have as much control over the rates here. Why? Because you can insure a myriad of different things underneath inland marine. Underneath underneath business personal property, you can't, right? I mean, you've got to find items that kind of fit in this nice cookie cutter definition of things that are going to fit inside your property within 100 feet. Right? Tables, chairs, we already went over the examples of what business personal property could mean. The insurance commissioner allows inland marine to be written on these categories below because insurance that is designed to cover your building and to cover the contents of your building, right, which is business personal property, do not provide the right kind of insurance for the following kinds of property that you see here. It's divided up into 3 categories. Property that's unique and unusual, property that's valuable, and property that's being transported. So it's almost kind of like we've been waiting to fill in this last blank, right? It's like, what is this in the marine? Now we know. This is where you're gonna cover items that can't be covered anywhere else. That's why insurance commissioners don't like it. Because you can actually insure everything from a bridge to a tunnel to a dock, all the way down to something small, all right? So let's break down each one of these categories here real quick. So property that is unique and unusual. Remember how I said how a city could own a bridge, own a tunnel, yeah, own a dock? Is that business personal property?
Sure.
Can that fit within 100 feet of your business premises? Of course not. So that cannot be considered business personal property, but you need to find a way to insure it, and this is how you do so. Piers, pipelines, radio towers, power transmission lines, radio, television, and communication equipment. Guys, you're talking about items that could be upwards of about $4 or $5 million, right? I mean, property that is nowhere near considered business personal property because near the sheer scope of the size of these things. Wind turbines, something I know we're all familiar with here in Kansas, okay? That's not business personal property, right? This is items that you have to insure a different way through inland marine. Now, there are a couple of key things you have to remember about these inland marine policies. Number one, they have 100% co-insurance, which means you can't under-insure any of them. You got a $5 million satellite, you're gonna insure it for $5 million. You're not gonna skip out on trying to under-insure that stuff, okay? 100% co-insurance, it's scheduled, which means it's gonna be listed separately, right? Every single bridge listed separately, every single tunnel, every single dock, every single radio tower, every single wind turbine has its own identification. And if it's gonna be listed separately, it's also gonna have its own what? Limit and its own premium. Absolutely correct, yes.
What about like a drill site for an oil company, like an oil rig?
I wouldn't know specific details about that.
Okay.
All I want you to know really about inland marine is that it covers pretty much everything that can be.
Okay.
I'm just trying to give you some quick
Sure.
examples. That's a great question, I just don't know how to answer it. Okay.
So you said that each thing on this policy has to be listed out.
Yes.
It's scheduled, and
Yes.
everything would have its own
Limit and its own premium.
premium.
Yeah, because I mean, you're insuring $5 million
Right.
worth of stuff, so yeah, it has to have its own limit. Yep, you got it.
Okay.
Okay?
So you can't
And it
lump-
also has a very, very high deductible.
So there's no lump summing it all together?
Nope. Not under this kind of inland marine, okay? There's only one way you can kind of lump some stuff together, and it's over here, and we'll talk about that here in just a second. But when you're trying to insure items that are unique and unusual, you have to identify them specifically. Okay. All right, so that's property that's unique and unusual. Property that's valuable. Now, there's a lot of things in this list here that we could go through. I really don't want to break them down because I don't want to confuse you, but I want to talk about this first one right here. An AR list. Account receivable, what is that? What is an AR list?
It's like when you get money in.
It's a list
Collect
of,
money.
it's a list of people who owe you money. That's what an AR list is, guys. It's account receivable list is something where you have been able to track who owes you money. Can an AR list, which is more often than not now going to be a computer file, be considered business personal property?
Sure.
No.
Can.
Why?
It's not business personal property. It's not items that you're using to run your business. These are items that you're using in order to maintain your books. Okay? So you, in order to protect for losses against an AR list, right? If you have an AR list, you've got a list of all the people that owe you money, and now all of a sudden that list is gone and you have no idea who owes you money. If you didn't have it in the marine, you can't be covered for losses caused by that. Okay? So this is property, that is a huge item of value to any type of business, right? Any kind of company or any kind of entity that owes you money, and now all of a sudden you lost the way to track them down, that's a huge loss, okay? Also, another item here that we have already talked about is contract equipment floaters. What are those? That's mobile equipment. Construction equipment, right? As I already kind of explained, bulldozers, backhoes, everything like that. that can now be covered underneath inland marine. You're talking about physical damage coverage now that could happen to it. Remember, liability purposes, it was already covered underneath business auto, but I'm not talking about any damage that happened to it underneath business auto. I had to cover it here. One that's, again, 100% co-insurance, and each item is listed, okay? The last one we need to break down is Bailey's coverage. Bailey's coverage is a form of inland marine. Remember what Bailey's coverage is? That's when the business accepts property of others and wants to protect it while it's in their possession. Okay? So Andrew, to answer your question, this is the only kind of bulk coverage that you can have, where you're trying to cover more than one item at one time and paying for one premium.
So is this basically like if I run a construction business and I have to rent like a couple of bobcats or whatever, would this be where I would lump them, or since I'm renting them and not owning them? Because like, technically they're under my possession for my business, would that be?
That's getting a little too specific.
Okay. I just didn't-
Yeah, I was about to answer you, but I think I'm gonna get off topic, so I would hold off on that. Just once again, try and keep it
So
simple.
basically like they're thinking the dry cleaners.
Yeah.
So my clothes go to you,
Mhm.
you're now in control of it.
If I own Bailey's coverage, I don't have to, right?
Yeah.
This is an option. But if I'm a business that accepts property of others while it's in my possession, I can protect it while it's in my possession, is what this is giving me an
Oh, yeah.
option to do, okay?
Thank you.
Yeah, you bet. Okay, so we went over property that's unique and unusual, property that's of value, and now, of course, the one that we've all been waiting to talk about, property that's being transported. If you are shipping items, whether it's by truck, rail, or air, or even by car, right? Because you can buy personal in the marine as well. This is where you cover it. You cover it with inland marine. Any item that's being transported. It doesn't matter, guys, if it's in a truck or not. If it's within 100 feet of the business, it's fine. It's still business personal property. But once it's outside of 100 feet, it becomes needing to be covered by inland marine, okay? Inland marine needs to cover. It covers property being shipped domestically by truck, rail, or air. Just as your reminder, business personal property is not covered when it's more than 100 feet from the premises, whether it's in a truck or not. A couple other definitions that we need to know. Floaters, something that can be moved. We already kind of, I think, addressed that. And then, of course, inherent vice is the process by which property naturally destroys itself over a period of time. Rust, damage to metal, things like that. Exclusions. If your bridge, if your tunnel, or your dock is damaged because of war or an act of war, could that be covered by their inland marine policy? Not this time.
No.
We already said war was one of the most common exclusions out there, right? Okay, same way with nuclear damage, wear and tear, bridges, over time, what do? They naturally break down, right? And they're made of concrete. That is not an insurable loss. That's when you're hoping your city has a really solid infrastructure in place to kind of replace that, because they're not going to be able to file insurance claims against that stuff, right? Process it just naturally breaks down. That's defining inherent vice right here. Okay, deterioration, insect damage, vermin damage, and the provision loss to a pair or set. That's very applicable, when you're talking about property being transported. Why? Because when property is being transported, it could mean that part of a set gets damaged in the process of being shipped. Does the insurance company pay you out the full amount of that loss? Nope, they only pay you the difference in value, right? Write out the term, difference in value, once again, right there to help you remember what that loss to a pair or set provision dealt with. They only have to pay you the difference in value. So right now, we're kind of in a commercial mindset, okay? And that's why I wanted to kind of address commercial inland marine first. But inland marine doesn't only have to be bought on a commercial basis. It can actually be bought on a personal level as well. Because remember what we said yesterday, when I had any item of value and I wanted to schedule it out on my homeowner's policy, what would happen? My premium would go up and up and up.
Right.
Think about this, guys. There's a lot of people that own a ton of property that's of value. And if they insured all of that underneath their homeowners would be astronomically high. So what do they do instead? They buy personal inland marine policies. More specifically, and this is a term I have seen on the test, so you need to know it, these are referred to as personal article floaters. Items that can be moved, not fixed items, but items that can be moved. Any property of value though, once again, we give you some examples here. Furs, jewelry, guns, baseball cards, stamps, you name it. Whatever is of value to you does not have to be insured with your homeowner's policy. You can buy these separate inland marine policies, okay? And of course, inland marine is gonna cover when it's being transported as well. So this is what I've actually been told is true, that a lot of bands who travel, that's how they actually cover their soundboards, their sound equipment, their musical equipment, is through inland marine policies, because it covers it not only when they're using it, but obviously when it's being transported as well. Okay?
What about over water? Where
Then you need ocean marine,
Okay,
but you're not tested on ocean marine.
okay, I didn't know.
It's a good question. That's actually where they came up with the term inland marine. Because ocean marine was actually the very first type of insurance coverage ever sold, period. Because it would only cover items that are being shipped overseas. And then someone was like, well, wait a minute, how do we cover property that's on land instead of on the ocean? And they said, oh, well, why don't we just call it inland marine?
Okay.
Yeah.
Okay, good idea.
You hear the word marine, you obviously think water, right? Yeah. No, this has nothing to do with water whatsoever. All right, so what we did was we kind of closed the book on that first chapter right there. Didn't we? I mean, we already kind of talked about that. The only one we really had to kind of define was builder's risk. But as we just stated, a business could own more property that can't be insured underneath here, right? Bridges, tunnels, docks, you name it. So what do they do now? They have to open up a new coverage part here, and this is called commercial inland marine. Okay. So commercial inland marine. Now, all of these are just options. These are not requirements. This is just giving you some examples that we just pulled from the previous page. In fact, another thing I want you to do for me right now is I want you to put the number 5.4 right down here, because I want you to have a point of reference when you're going through this tonight or tomorrow to remember where we actually talked about in the Marine Act, okay? And it was down at page 5.4. But these are the ways that the business is actually protecting their property, isn't it? Property that can be covered as business personal property and now property that can't. But everything that the business owns is kind of covered by these first few coverage parts here. So let's kind of close the book then on property coverage for right now. And if we're closing the book on property, that means we're probably moving over to what?
Liability.
Liability. And guys, as a business owner, your liability concerns are some of the most expensive that they could ever be. I mean, if you think about it, when someone wants to sue a business, the lawsuit alone could literally put that business out of business, okay? And there's so many different things you can be sued for. And a lot of these sometimes people haven't even thought of, and so that's why it's got its own page that we needed to dedicate to it, and this is called Commercial Liability Basic Hazards. There's a lot of information on this page, guys, so we're gonna break this down just as simply as I can, not quickly, simply as I can. So, whenever we talk about liability, up until this point, it's always been kind of associated with two word phrases, bodily injury and property damage, right? Okay, so think about this. If someone gets injured, or if someone's property gets damaged as the result of something that happened because of the business, isn't the business going to need to be covered for those kind of losses? Yeah. And we're going to call those one of two different things, either premises or operations, okay? You need to know these two terms. We're going to use them a lot today. Premises coverage and operations coverage. Quite simply, guys, premises operations coverage comes into play when either bodily injury or property damage happens on business property. Can't make it any simpler than this. If someone gets injured or their property gets damaged while on business property, that's premises coverage. That's what needs to take over. But in the course of doing our job, is there a chance that we might injure someone or damage their property away from business property as well? Mm-hmm. There is. Okay. But we're in the course of doing our business here still, right? An employee of the business is still on site. They're just not on business property, right? They're maybe at the customer's house, or they're doing some kind of, seminar or something like that, some kind of workshop. So in that kind of case, when someone were to get injured or their property were to get damaged away from business property, that's called operations. I'm trying to use my words to describe this, guys. You can utilize the words up here if you want, but I'm just trying to break this down the way that I learned it. If it happened on business property, that's premises. If it happened away from business property, that's operations. In both cases, though, in order for one of these two to start, for these to be covered, a business representative had to be on site. Of course, premises operations or premises coverage, that would make sense, right? But operations, why does a business representative have to be on site? Because we're gonna have to prove that it was a result of that representative's action that the property damage or the bodily injury took place. It was something that they did that caused the injury or caused the property damage. All right? So that's bodily injury and property damage coverage for the business. It's called premises and operations. This is a BIPD coverage. If you want to put BIPD up here, that's fine. If that helps you, but that's exactly what it is. It's a bodily injury, property damage coverage. Whether your employee caused the damage on site or did not, that's going to be premises or operations. Okay? Now, the next two are a little bit different. They are not bodily injury, they are not property damage coverages, but they do need to cover items that we could be sued for as a business. And the first one that we want to look at is one we looked at already today and yesterday, personal injury. Like advertising injury, it won't cover for bodily injury and property damage, and we'll go over advertising injury here in a second. I want to start here with number 2. It would cover if the business wrongfully entered or evicted a person from a room, a dwelling, or premises that the person occupies. If the business had somebody falsely arrested, if the business had someone wrongfully detained, imprisoned, or maliciously prosecuted, the person who that happened to, could that affect them for the rest of their life?
Oh, yes,
Will they sue for that?
sure.
Will your premises and operations coverage cover that? No,
No.
because that's not bodily injury and that's not property damage. So now you have to think about what's going to happen if someone sues you for something like that. That's when you need personal injury. Or think about this, if you're a business and you accidentally infringe on someone's copyright, their slogan, their title, their way of doing business, right? Say you're a small business here in the state of Kansas, and you pick out what you think is a catchy slogan or a catchy theme, and you use it for about 6 months. Then about 6 months later, you get this cease and desist order from a lawyer on the East Coast that says, my client's been using that slogan for the last 20 years. This is the order telling you you have to stop right now. Oh, and by the way, we're suing you for damages. Those kind of things happen, guys.
Yeah.
If you don't properly research slogans, titles, ideas, things like that, you could very well find yourself actually being sued for copyright infringement. Is that a bodily injury or property damage?
No.
No. Did someone's reputation really get hurt here? Not really. What did you do? You stole an advertising idea. So that's when you would need advertising injury as well. Advertising injury is not a bodily injury or property damage coverage. But now you're starting to kind of get into it. You're starting to understand that business owners have a lot of concerns that they need to think about. A lot of liability concerns when running their business. They don't just have to worry about if someone gets hurt on their property. They got to get worried about if someone sues them because they get wrongfully arrested. They got to worry about if someone sues them because they stole their idea, right? I mean, that's a lot that business owners have to take on. And that's why we call these hazards, increasing the chances that these losses might occur. You advertise a product, that increases the chance, right? You have any type of interaction with the public, that's going to increase your chance of hurting someone's reputation. You actually have someone coming in and off your property over and over and over again, that increases your chances that losses might occur. Okay? So, we broke down premises and operations, advertising injury, personal injury, a few others we need to go through. First one's called fire legal. Fire legal is also determined to be tenant liability. So these are all liability concerns here, but now we're talking about the business that rents property from somebody else. Right now, I am renting this property from my property manager, from my landlord. Let me ask you this. If, over the next couple days, I accidentally leave something in here that could cause the carpet to catch on fire, the walls to catch on fire, and this part of the building that I rent, if it burns, explodes, or if any other kind of major damage happens to it, how would my property manager try and make up for that loss, what are they gonna do? Sue me, absolutely they are, right? They have the right to recover that money from me, don't they? Of course they do. And if I don't have tenant liability in place, guys, that's not gonna be covered underneath my business owner's policy. That's not covered underneath my commercial package policy. I'm gonna have to make sure I had this included in it, okay? Tenant liability, fire legal, covers for damage caused by an insured to that part of any building, leased or rented if it should burn, explode, or other stated perils in the policy for which the insured could be held legally liable. Now, I did misspeak here a second ago. I said it's not included in business owners, it actually is, but we haven't addressed business owners' liability yet. That's why I kind of misspoke here. But what you need to understand is what the definition of this is, right? The definition of it is basically you are renting property that's not your own. If you damage it, you want to be covered for losses by that, okay? And that's tenant liability, also called fire legal. Another liability thing that you need to know about is medical payments to others. Where did we see this yesterday?
On liability for
On your homeowners, right? Section what?
2,
Part
A, B, E, F,
F.
F.
Coverages for my friends, right? Does that all ring a bell?
Yeah.
Medical payments to others, okay? So once again, what was the purpose of medical payments to others? It was going to pay medical bills to others regardless of negligence or fault. Doesn't matter who is at fault, doesn't matter who is negligent. Why? Because the insurance company's ready to write the check right now. Cut it, here you go, let's let bygones be bygones. Why is it good for business to own this? Because if they have medical payments to others coverage and someone gets injured on their property or away from their property, they don't want to use this. Why? Because that means someone has sued them.
Yeah.
If they use this, no one sued them, guys. The insurance company just paid it out regardless. Okay. The last two we need to look at here are product and completed operations. Couple more liability concerns that businesses have. I'm sure I've already kind of expanded your idea of what owning a business is really like, but I'm about to blow it up even further. If you manufacture a product, remember what I said about manufacturing a product yesterday, could you be held liable for any damage that product could cause to someone? Whether or not they were using it in a negligent manner? Yeah. We called that strict liability, didn't we? Right? Strict liability. So all the claims underneath product liability are handled on a strict liability basis. What did that mean? That meant that it didn't matter if they were using it negligently. Didn't matter if they were using it for something it shouldn't have been. You should have protected them from themselves, is what they're going to say. Right? You should have had safety standards in place. That way, if they did disengage the safety standards, then you could say that they tampered with the product and therefore won't be able to collect. Okay? So here's how product liability works. It's going to cover for bodily injury and property damage coverage. So just like premises and operations, it's a BI-PD coverage, okay? Someone gets injured or property gets damaged because of a product. Now, it wouldn't cover damage to the product itself. We're talking about the coverage for the people it hurts or the damage that gets or property that gets damaged because of it. This is the key part. Please underline it starting right here. To be covered, the injury or damage has to have occurred off business premises. Why? If I'm on business property and I'm messing with someone's product and that product hurts me, why is that not product liability?
Because you're on your own premises.
Exactly. I'm on business property,
Yeah.
which means that it doesn't matter if I'm messing with a product or not. If I'm hurt on business property, what should take care of that?
Premises.
Premises should, right? So a product liability coverage is an always off-premises coverage, except for one case, and that's if I'm a restaurant. And here's why. A restaurant's product is its what?
Food.
You bet. And where's the food normally consumed?
Restaurant.
On site.
Mhm.
So in the case where food could cause bodily injury, not property damage, not sure how food could cause property damage, right? But if food causes bodily injury, that's still a product liability, okay? But that's the only time you're talking where product liability can be on-site coverage. Everything else, you had to have been off the business premises. And the product has to be under your total control. That would mean that there's no other person on site. There's no business representative on site, right? Because remember, if I'm away from business property, but yet it's an employee who has control over that product and they hurt me with it, is that product liability? That's what? Operations. Okay. We're trying to draw some major hard lines here, guys. I know this is a stretch because it's really hard to think like this as a business owner, but these are the things that you're going to be tested on. You've got to know these terms.
Okay, so let's say it's a gun,
Okay?
and, I mean, like, they manufacture guns or something, and there's a defect, maybe because he took the firing pin out or something, I don't know, and he shot me, it's under operations,
If it was on site,
yeah.
or I'm sorry, if it was away, if it was like on your premises, on
Yes.
your property, yeah, that'd still be operations. Why? Because he's still there. Yeah. Yeah. Anytime any type of employee is there with you, right?
Yeah.
Then that's going to be operations coverage. The only way product liability can come into play is, number one, you're away from business property and it's under your total control. Like, remember what we had talked about yesterday with the Black & Decker lawnmower, right? That's a product liability case.
Right.
Because, of course, that person was using it negligently, but it didn't matter, right? The product was under their total control and they were away from business property, okay?
Okay.
So that's product liability. The last one you need to know is completed operations. Completed operations, once again, is a bodily injury property damage coverage, only now it's going to provide coverage after the job is done. It's going to cover defective workmanship. It's going to cover bad designs that could cause any type of injury or property damage. Basically, what does it mean? They did the job poorly. They did it wrong. There was a flaw in its design, and because of how they did their job, once they leave the scene, once they're gone, it could be 5 or 6 years after that design flaw was actually originally done. But if it's 6 years down the line and that design flaw now hurts somebody, can that business still be sued for that loss?
Yes.
Of course they can, and they need a completed operations coverage for that. Okay? Completed operations is a project-driven type of coverage, right? Because if you're doing a project, once you're done with that project, you're gone. You're not on site anymore. And if that project were to hurt somebody else, right? Say it's a concrete company and they're out there laying a sidewalk, but they didn't actually level it off the right way, right? They're gone, they leave, but I noticed that it wasn't leveled off the right way, so what do? I take a picture of it, and then 2 weeks later, someone's walking along and trips over that and actually really hurts their knee up pretty bad. Could I sue the company who did that concrete work? Yes, I could. Because I've got proof now that they didn't do their job the right way. Completed operations, okay? So that's what completed operations is. It will cause, or it'll cover any design flaws that would cause an injury or damage any time in the future. The insured had to have finished the job, done, right? They're completely gone and left before the occurrence. See, if they were on site when that injury happened, what would that have been? Operations, right? Anytime any of your employees are on that project site, then that's still going to be covered in operations coverage. But, excuse me, completed operations are always going to be an off-premises exposure. Right? So there's a lot of things that we just unpacked there, but there's a lot of things out of this list that you very well could see on the exam. All right? So you just have to know these terms. You got to know what premises is. You got to know what operations is. You got to know what advertising, personal injury are. You have to know what product liability and completed operations liability is. But now do you understand why we kind of wait till the end of day 2 to come up with this stuff? Because you've got to put yourself in the mindset of a business owner here. There are so many different ways people can sue you for how you run your business. Okay? Especially depending on what type of business you actually run. Injuries to employees, they're obviously covered under workers' comp. Okay? And injuries caused by an employee to another employee is still workers' comp. However, an injury caused by employees to anybody else, right? Anyone else, as long as they're not an insured underneath the commercial policy, is going to be covered by either premises or operations. That's the big one, right? That's the big one, where employees on site, they hurt somebody, it doesn't matter if they were on business property, if it was its premises, or away its operations.
As long as they're not employees themselves.
Exactly, because if an employee hurts another employee, that's still workers' comp,
Okay.
okay? It's a lot of stuff to break down, guys, I know, but let's go ahead and break down, or go back to this box right here, commercial general liability deck page. So here's now where you're gonna address what type of liability concerns you as a business owner have. Do you have to have all of these? No. But boy, it sure sounds now that we've broken them down, probably a decent idea if you do, right? Especially the bodily injury and property damage coverage. For one, if you have people coming in and off your property, or if you're gonna be going off-site and sending your employees to do jobs for you away from business property, having a premises and operations coverage probably gonna be mandatory. Product and completed operations, maybe not as mandatory, right? Maybe you're not a manufacturer of product. If you're not, you don't need product liability. If you're not a project-driven business, do you need completed operations? No. See, you can pick and choose here, guys. You don't have to have these things. They are just, well, remember, you're building these things from the ground up. You're deciding which one of them you want, okay? Same way with coverage B. So coverage A was bodily injury and property damage. Coverage B is not, right? That's personal and advertising injury. That's not bodily injury, that's not property damage, okay? But it's still financial losses that people can sue you for, so you better have some kind of coverage for
Are
it.
they mandatory?
And then, what's that?
B and C are mandatory? No,
None of these are
Optional.
mandatory.
these are all.
None of these are mandatory.
Building from the ground up.
Yeah, I mean, if you just remember one thing, that this policy is designed from scratch. You're only gonna pay for what you choose, right? You wanna put it in, like food terms, this is like choosing a la carte, right? You're just kind of picking which items you want. What's business owner's policy? That's kind of like a value meal. Everything's already done for you, right? You don't have many options there. But here you have all the options in the world. And then, of course, coverage C, medical payments to others. That's another one. So go ahead and do me a favor and put the number 5.5 over that box. That way you have some cross-reference as you're working your way through your manual tonight, trying to study to get ready for this exam. A couple other terms that we need to go over, definitions. The term aggregate. Remember what the term aggregate was when it came to liability coverages yesterday? That's the maximum amount that any insurance company will pay for all claims combined, period. Right? So it doesn't matter if it was 1, doesn't matter if it was 2, doesn't matter if it was 10. This is the maximum amount that they're going to pay in any one policy, period. Aggregate limits, once again, are only specific to liability, not property. Okay? Aggregate limits are specific to liability, not property. Lawsuit or claim, when the claimant or plaintiff asks for compensations for injuries or damages. Medical payments to others, we already went over the definition of that, designed to discourage lawsuits by providing medical expenses regardless of fault. Mobile equipment, we already know what mobile equipment is, right? Land vehicles, self-propelled or otherwise, usually not licensed for the road. There's some more examples here that we haven't really addressed yet. Bulldozers, farm machinery, forklifts, items permanently attached to such equipment such as a cherry picker, street cleaner, snow removal, and any vehicle that travel on crawler treads. What you need to understand here, any vehicle that has wheels on it that's not really supposed to be driven on the road, okay? That's what mobile equipment really is. Occurrence, very important that you know the definition of occurrence, guys. Remember, if everything can be traced back to one event, one accident, then anything that happened as the result of that accident will still only be paid underneath that one claim. Right? Because didn't we say how insurance companies set the per occurrence limits? Right? And if it can be traced back to one event, one accident, then absolutely that's all they're going to have to pay for. Okay, that's the per occurrence limit, the maximum dollar amount the policy pays in damage awards for any one occurrence. The per person limit, of course, is the maximum dollar amount the company will pay any one individual or given claim. Out of those two limits, which one has to get hit first? Per person limit first, right? If you hit your per person limit, did it matter if you fell underneath your per occurrence? No. Right? But if you didn't hit your per person, then you got to go to your per occurrence. But if it falls underneath both of those, then you're solid. Okay? Supplemental payments. We already kind of know what these are. We've really kind of broken these down a few different ways already. This is just a much more wordier way of viewing it. Pays for defense, investigation, and claims costs incurred on behalf of the insured Insurer also pays for the insured's lost wages while attending trials or hearings. Premiums on bail and appeal bonds, there's that again. Pre and post judgment interest, there's that again. And then of course any other costs that you're asked to spend on the insurance company's behalf. Big thing to remember about supplemental payments, guys, is they are always paid in addition to the limits of liability. They never affect it, right? All of this stuff right here can never affect your limit of liability. They will always pay on top of it. And the last thing to go over on this page right here is territory of coverage. Where do the losses have to happen? In order for them to be covered under property, we already went over what that was, right? And the territory of coverage, it was the United States' possessions as long as it was within 100 feet of the business property. Yeah, that's not true here. Underneath commercial package policy, your territory of coverage is usually the United States, right? This is where the loss has to happen. The United States, its possessions, Puerto Rico, Canada, international waters, and now airspace. However, it can be all parts of the world, and probably would need to be if you're talking about product liability, right? Because sometimes when people are using their products, they're probably using them in all different parts of the world. So how then can you be covered? If your product were to hurt someone halfway across the world, how in the world can you still be covered with that? If it can be proven that the product or the good was sold within the coverage territory, within this area right here, then it's all parts of the world, okay? So as long as you can prove that the product was sold in the United States, its possessions, Puerto Rico, Canada, international waters, or airspace, but then say the product made its way halfway across the world to Japan and they're using it over there in Japan and all of a sudden get injured because of it, is that still covered? You bet it is. Yep. But if the product was manufactured here in the United States, but then shipped to a different country where it was sold, what would happen then? Who would have to pay for the damage if that product were to cause any damage?
Just sell it over there.
It would actually be the manufacturer. They'd have to pay for it out of their own pocket
Okay.
if they got sued for that, because the liability coverage wouldn't cover it. Now, there is one major exception to this, and that is when you're talking about things like advertising injury and personal injury. Because when someone defames somebody, someone wants to talk bad about a business, someone wants to actually hurt someone's reputation or even steal their reputation, or steal their ideas or steal their slogans, where does that crap normally happen now? Through social media, doesn't it?
Oh, yeah.
Through the internet. So they actually had to expand the coverage territory underneath the territory of coverages for liability purposes. For advertising injury and personal injury, that is now including the internet. Okay?
Unbelievable.
Because if someone wants to sue you because of something you said about them on the internet, they can. But now at least you would be covered if you at least had the liability coverage, personal injury or advertising injury, depending on which one it was. Okay, so that's the key one right down there. As long as it was sold within the coverage territory, or if it's through the internet for, personal or advertising injury. All right, so as we continue to move forward now, we're still focusing on liability, right? We haven't moved from liability yet. But one thing I need you to remember was that when we talked about property coverages, not only did we talk about what kind of property we were insuring, we talked about how we were insuring it, right? With what coverage form. There were 3 different options, right? Basic, broad, and special, right? Was it going to be a named peril policy, or was it going to be a named exclusion policy? Up until this point, we really haven't needed a coverage form for liability. But for business liability, okay? So for premises and operations, for product liability, for completed operations, for tenant liability, for medical payments to others, for personal injury, for advertising injury, you now, as the business owner, have to choose one of 2 forms. That's all there are, okay? So there's not a lot of them, but you do need to know how both of these forms work. And it has to do with their title. They're called the occurrence form and the claims made form. And if you're trying to make out the difference between what's so special about one to the other, it's about its title. What matters in the occurrence form? It's when the occurrence took place. And one thing that we've learned from the very beginning, I'm talking like back from page 1.3 or 4, when we talked about the policy period provision, what did we say always has to take place during the policy period?
The laws.
The loss, the occurrence, the accident. So in order for you to be covered underneath the occurrence form, all you have to do was prove that the loss that happened while it was in your policy period. That's it. That's not changed, guys. This is not new information, okay? That's not new at all. Because the claim can be made any time in the future. All you have to do is prove the occurrence, right? What happened. The accident happened while you were under policy. That's all you have to do. That's the easy one. But it's also the more expensive one. The second option is called the claims made form. So it's not so important now when the occurrence took place, but it's when the claim got made. Because under the occurrence form, remember, all you had to do is prove the accident happened during the policy period. You didn't have to prove anything else. The claim could get made any time in the future. Underneath the claims made form, guys, if you choose the claims made form, not only do you have to prove that the loss happened during your policy period, but what else has to happen during the policy period? The claim has to get filed during the policy period. So that's why we have these two separate names for them, but the difference between the two is in its name, okay? The occurrence form only has to do with when the occurrence took place. The claims made form is very important to know when the claim got made.
Okay, so my ADD is working here. We are the business that's purchasing
Correct.
this insurance.
Yes.
For our people that are on our premises? Or for?
Possibly any
or-
type of liability coverage. Product liability, completed ops, whatever kind of liability coverage you select. This is now telling the insurance company when they're going to be responsible to pay and when they're not.
Why don't we just let the person that has the claim try to prove?
I don't understand your question.
Now I'm trying to figure this out.
Okay.
Because if they wanted to make a claim against us, wouldn't they have to prove their claim against us? Why would we have to have this so they could collect their money?
You would have to have either one of these in place to make sure that the insurance company knew that they were responsible to pay for it. Because remember, when you buy this policy, right, it is your responsibility now, not only as the business owner, to say, yes, I'm covered, but now go to the insurance company and say, insurance company, I'm not responsible for this loss, you are. Right? This is how the insurance company is determining what they're responsible to pay for and what they're not.
Yeah, okay, I got it.
Okay. I didn't know if that helped you or not.
Yeah.
But, okay. All right, so these are the two types of claim or type of liability forms out there: occurrence and claims made. Now, there doesn't need to be any endorsements made to the occurrence form at all. Everything's done for you here, right? Everything was already done. All you had to do is prove the loss happened during the policy period, and that's it. But underneath the claims made form, you very well might have to add on an endorsement, something that could actually increase your coverage. That's the word I was looking for. Okay, you're trying to increase your coverage, and you can do it in one of a few different ways. First one is you can add in a retro date. Places a limit on how far into the past coverage is afforded for prior occurrences. Usually the policy inception date, however, could be provided for as far into the past continuous coverage was held. So what this is now stating is that if you have one of these claims made forms, right, it didn't matter that the claim or the occurrence happened during the policy period, it happened when the claim was made, right? So what the retro date now states is that they will actually extend past the time that you will actually bring it back for the time when the claim could have been made against you or the business, right? More specifically, the business. Remember, you're not actually increasing the occurrence time here. Everything that's true about this first sentence is all the way back from the policy period provision. That will never change. Okay? This has everything to do with it when the claim gets made. So you can retro it, you can actually extend it. Okay? You can use it to extend the claim reporting period beyond its expiration date. There's two different ways you can do that. Either with the extended reporting period, which is automatically included at no extra charge, but it's either going to be 60 days or 5 years. So after termination of the policy, the 60-day reporting period is in effect for any claim. If the insured reports anything, any accident that may have taken place during the policy period, guys, we're not talking about this extra 60 days, right? Basically, the time frame is done, but we're giving them 60 more days to say, yep, we forgot to tell you, something happened here. Something happened during the policy period. And because we reported it in that 60 days, then we can actually extend coverage to last a total of 5 more years. Hoping that if someone was going to file a lawsuit against us because of that incident, because of that accident, that they did so within that time. Because if they didn't, and it's like 10, 15, 20 years down the line before someone finally does sue you for that accident, for that occurrence, would your insurance company have to pay out? Not if you chose ClaimsMate, they wouldn't. See, that's what you're doing. You're extending your coverage here. You're actually adding on these endorsements to help out your insurance company pay out more claims than maybe they really should have. Now, are they going to make you pay more for these endorsements? You bet they are.
Supplying yourself more time.
Pretty much. That's what this one is too. The supplemental extended reporting period, you can purchase that as an option, and it provides an unlimited extension for claims from occurrences that took place during the policy period, and it takes effect after this. So, once again, you report something in that 60-day time frame that happened during your policy period. We're like, we still haven't seen any lawsuit, but we're just waiting. Nothing happens in the next 5 years. What are your choices? You can kind of hope that nothing ever happens, that no lawsuit ever happens, or you buy this. The insurance company, once again, allows you to buy more coverage, only now this is going to cover you for the rest of however long your business is, is going to be enforced, I guess. Your policy is going to be enforced. But here, this one right here, this is the only endorsement that you can really add after that policy's been enforced.
After that policy, if you don't add that supplement, they can come back and sue you personally.
Yeah, absolutely
Okay.
they can.
All right.
So why would you have to add this on? Because you know that something bad happened.
Yeah.
Right? You know something bad happened while you were covered with your insurance company, but you still have yet to see that claim. And you're like, well, crap. What are we going to do now? We're just waiting. It's almost like you're waiting for the other shoe to fall. You're waiting for the next thing to happen, but it hasn't happened yet. Can you take a chance and hope that they never do? Sure. But if you do, what's going to happen if they do file a lawsuit against you? You may end up having to pay for that claim out of your entire pocket. Right? The insurance company may come back to you and say, sorry, we're not covering you. Okay? All right, so another way I want to illustrate this real quick, and you're going to have to pardon my art, but it's just to help you illustrate the idea, the difference between these two, is to tell a story that's very comparable to the story of Erin Brockovich, if anyone's ever seen that movie. Okay? So basically it's the story of Love Canal. There was a canal that ran right through the middle of this city, okay? And that's why people lived there. There was this huge residential area. There was a big church. There were schools, right? People swam in this. They drank this water, right? They fished in this. This was a huge centerpiece for this entire town, okay? Few years later, though, some factories started going up literally on the other side of the canal. That area, for some reason, hadn't been developed yet, okay? Now, when those factories went up, they were all insured with an occurrence form. The company that put these factories up, they were insured with an occurrence form, okay? We're going to just call that company ABC, for lack of a better term. All right, so this company, ABC, is insuring these factories with the occurrence form. Now, about 15 or 20 years later, after those factories went up, people in that town started getting really, really sick. Nosebleeds, cancer, rashes, sometimes death, birth complications, you name it. Right? Almost anything that could happen to the citizens of this town was happening. It was really, really bad. And so what they ended up doing was they hired a private investigator. And the private investigator, in his research, actually found out that when these factories went up, they were improperly disposing of their toxic waste. It was actually being leaked inside of this canal for God knows how long. All right? But it was traced back to this one event. This one occurrence, okay? It was traced back to this. Now, 15 to 20 years later, they're no longer with an occurrence form anymore, okay? They're with a different insurance company. Let's just say it's C&M. So we'll call C&M ClaimsMate Form Company, okay? That's who they're with now. right? They've long since left ABC, right? They've gone through a few different insurance companies since then. So 15 years later, when this discovery is made, they're with a different insurance company. That lawsuit, class action lawsuit, was brought against a judge, and a judge found in favor of the town, and the town was awarded over $650 million in cash. Now, who paid that loss? You've got three different options here. It's either ABC, C&M, or the company paid for it out of their own pocket. How many people would say that company ABC would be responsible for that loss? Raise your hand.
They didn't have the extra insurance.
How many people say C&M? How many people say the company had to pay for it out of their own pocket? How many people are ready to go home? There we go. There's more hands. All right, the answer to this question is A, B, C.
The occurrence started.
Because all they had to do in order to prove that ABC was responsible was prove that what happened? The occurrence happened during the policy period. And did it? You bet it did. So ABC, even though they hadn't insured that company for 15 or 20 years, actually had to help them pay out that loss. Okay? $650 million they had to help them pay out. Does that make sense though? Why they would? Do we know now the difference between claims made and occurrence forms? Let's just say that they were with C&M from the very beginning. The claims made form, okay? And if they were with C&M from the very beginning and then 15, 20 years later that exact same situation happened, filed a class action lawsuit, found in favor of the town, who would end up having to pay for that loss?
Oh, no.
They were with him at the beginning, you said?
Yeah. Let's just say they were with the same company, C&M,
From the very beginning?
from the very beginning.
Out of the
Did they
policy.
And then you moved on to a different insurance company. Right? Oh, sorry, I should have, I apologize, guys, I jumped the gun. So once again, 15, 20 years later, they're not with C&M anymore. Let's just say they're with a different company, ABC. That's my fault, I apologize. Okay? So if they're with a different company now, they started out with C&M, a claims-made Ford company at the very beginning of their policy, right? The very beginning, once the policy, or the factories went up, and then 20 years later, now they're with ABC. Okay? Doesn't matter if ABC is a claims-made form company, doesn't even matter if they're an occurrence form company. Who has to pay for that loss?
C&M, because they were the very beginning.
C&M is a what kind of form? It's a claims-made form. What had to have happened in order for C&M to be responsible?
False
The loss had to have happened and
claim.
did the claim get filed here? It didn't. So if that situation had played out in that way, who would have had to pay out for the loss?
The company.
The company would have.
Okay, so why didn't the company have to pay out it anyway since they were illegally dumping? Is that just because it's a negligence act? It's no fault?
Yeah, that's getting too much into the semantics of it.
I just didn't know if that would have played a fault, like because I know negligence
Right.
doesn't play a fault.
I think, yeah, negligence definitely had something to do with it.
Okay, I just didn't know if that
They
was-
say they did it unintentionally. Of course, we could argue that they knew what they were doing,
Oh, yeah.
but you don't know.
Okay.
Okay? All right, so now do we know the main difference between claims made and occurrence form? Right? Everyone good? Jen, you're looking at me like, no?
Yeah, I got it.
You got
I was
it?
just gonna be.
Okay. Don't make too much of this, guys. Just focus in on this part right up here. If this part down here confuses you, then just ignore it. Just know that everything you need to know about these two forms comes in right here. This one, you'll never have an endorsement. Why? Because everything's covered for you. This one, you will possibly need endorsements. That's all you need to remember. Okay? All right. Last page we need to go through is this page right here. Talking about crime. If you want to be covered for losses caused by crime, you now have to tell the insurance company what type of crime you want to be covered from. Yeah. Gets very, very nitpicky. And now the best type of crime coverage that you can ever choose, though, is called theft. See, if I choose theft right here, that would cover any act of stealing. That is the best type of crime coverage you could ever have. Okay? That is the best type of crime coverage you could ever have, is any act of stealing. Okay? So if I want to be covered for theft of money, theft of securities, theft of cash, theft of business property, whatever, I've got to actually tell them theft. But if I do, they're probably going to charge me the most for it, right? Because it's the best one out there. Or maybe I just want to be covered for losses caused by burglary. What is burglary? That's taking a property with evidence of forced entry into or out of a premises or safe. But this is why it's called burglary, guys, because of this next part. Underline it, please. After hours. No people can be present. If I go to my insurance company and I tell them I want to be covered for losses caused by a burglary, number one, have to prove that there's been forced entry into or out of the property. And number two, the insurance company has to know without a doubt that no one else was on site. That means I couldn't have had a watch person there, right? Who's a watch person? That's any person I retain specifically to have care and custody of property inside the premises, and they have no other duties. If I employ a watch person, I can't be covered for losses caused by burglary. Because there's someone there, guys. That's how nitpicky they're gonna get. They say you can't have a watch person there. You can't have a custodian there, who by definition is you, a relative of yours, or any of your partners or members, or an employee while having care, custody of property inside the premises, excluding any person acting as a watch person. Why? Because that's not your job, that's theirs. However, if you have any of these people on site and a burglary happens, it happened after hours, you're not gonna be covered for that loss. Why? Because someone was actually there. Right? That's how nitpicky they're going to get. Now, if you want to be covered for losses caused by robbery, though, you can choose that one. That's the taking of property by causing or threatening bodily harm. Why? Because that's going to happen during hours, while people are present. So it's happening either during hours or while someone is there. So can I be covered for losses caused by robbery if it's after hours, but there's a watch person on site? Yes. That is robbery, because someone was there. And if someone was there on site, they were under threat even if they didn't know about it, right? Because someone was on property, whether they because even though they didn't belong there, they were there, and that actually caused the threat. All right. So you've got to know the differences between those three, between theft, burglary, and robbery. Those are three very different definitions. Well, what happens if something just goes missing? We know something is missing, but we can't prove it. There is nothing. There's no evidence of forced entry here. None. We just know something isn't there anymore. What is that called? Mysterious disappearance. Guys, if I haven't actually told my insurance company I want to be covered for losses because of mysterious disappearance and that happens, they're not going to cover that. Once again, nitpicky. If I had chosen theft, though, could they have covered that?
Sure.
Of course it could have. Other types of loss: extortion, the surrender of property away from premises as a result of a threat to harm you, an employee or a relative who is being held captive. That's extortion. That's definitely going to cause a loss. Pilfering, stealing small amounts at a time. Petty crime. That's actually how most employee thefts are actually discovered. Right? Whenever someone buys one of these employee honesty bonds, this is what happens. One item of theft is discovered, and the insurance company actually allows the business owner 2 years to go back in the history and discover if that employee had taken any more money before they were actually caught. Right? They'll look in their records and they're like, hey, that amount of money that went missing that we caught that guy with, that's the exact same amount that was stolen 6 months ago. Oh, and then we had another loss 9 months ago. And then you slowly realize that this person's actually been doing that from you from a long time. And you can all make that part of that one claim under your fidelity bond. Okay? Excuse me. Forgery and alterations, that's another loss: process of making, adapting, or imitating object statistics and documents with the intent to deceive. These are all sorts of crime. And if you want to be covered for losses caused by crime, you've got to be very specific. Do I want to be covered for losses inside the premises for theft? Do I want to be covered for losses inside the premises for robbery? Do I want to be covered for losses outside of my property for burglary or robbery? These are the kind of things you have to be specific on. Okay? So this is all showing up on page 5.8. So as you go back here to this page, I want you to put the number 5.8 right down here at the bottom of this last square. Because it's kind of like we already addressed. We already went through the property, right? We went through the inland marine. We went through the liability, and then the last but not least, we have to decide what type of crime we want to be covered from. The coverage form, the claims made, or the occurrence form has to be decided here, okay?
So you would just say get theft basically because it covers everything.
You could, but it's also gonna cost you the most money, which is why some people don't choose theft, right? They choose burglary or robbery or mysterious disappearance, okay? So these are just some examples. Inside the premises, being covered for theft of money or securities. Inside the premises, being covered for robbery of safe or burglary of other property, or inside the premises, robbery or burglary of other property. These are just examples, guys, but you can just fill in the blank. There's actually over 30 different crime definitions in the state of Kansas alone that you can be covered from, okay? But here's what happens. They take all of these property forms, or all of these coverage parts, excuse me, and they add up all your coverages here, they add up all your coverages here, here, and here. Remember what I said, you only pay for what you choose because you designed these from scratch. So you added up all of these premiums right here from all single one of these deck pages, and you put the premium total right here on the deck page. Now let me be also very, very clear about something. This does not happen overnight. The CPP policies sometimes take months to put together, right? Because you're talking about a ton of reporting, a ton of different research, a ton of different things. I mean, inland marine alone could take you forever to try and identify every single item that you maybe want to be covered for, okay?
Would there be a binder? Would somebody be
What's that?
binding this insurance while it takes months to cover?
I wouldn't say so. I mean, maybe, but it just doesn't happen overnight,
Yeah.
right? That's one of the best things about the business owner's policy, right? Probably took a day or two to put that thing together, and that was it. These things take a lot longer to put together. So they come up with all of those premiums, put that premium right up here, and then not only do we determine how much they pay, but we also are to determine how often that they pay. How often they pay is defined by their mode, M-O-D-E. Know that term, please. How often you pay your premium is your mode. And guys, some of these policy premiums are so high that they pay their premium every single week in order to keep from paying a huge bulk payment I had at the beginning, right? They actually pay premiums to their insurance policy every single week. Most of them not, but some of them they can, okay? So that is how the CPP works. Everything wasn't done for you. You had to build it up from scratch. This is very messy. This takes a really long time to put together, okay? But the last thing I told you I wanted to address today was the liability coverages underneath the business owner's policy. So we're flipping back to this page. And yes, underneath the business liability, section 2 of your business owner's policy, the BOP, all of these liability coverages are covered. They throw them in for you. Thank you very much, business owner's policy. But I want you to look at that number that's right underneath business liability. $300,000 per occurrence. And there's an aggregate on these as well, and it's double it. It's only $600,000 for any claim that could happen during one policy, or any claims that could happen during one policy period. If I'm a small or medium-sized business, chances are people aren't going to be filing lawsuits against me. However, if they do, is there a chance that they could sue me for a heck of a lot more than that?
Sure.
Absolutely. So that's the reason why people don't like some of these business owners' policies, is because simply of that limit right there. I mean, you're talking about if anyone gets injured on your property, you hurt someone's reputation, you steal their idea, you steal their slogan, you had a product that you manufactured that hurt them. Because of the way you actually completed a project, someone got hurt. Your building that you rented is going to get damaged because of fire, or you have any other payments to someone that's going to pay out regardless of fault, this still goes toward that total. $600,000 is the maximum that they'll pay for any claims in that one policy period. So that's why it took me a while to come to this, because we hadn't defined these yet. But now we do. We know what these mean, right? Do me a favor and put 5.5 again right here, because those are the pages that we broke down what those liability coverages were. Very, very important that you know all of that, okay? It's a very involved section, I know. I apologize. I wish there was some other better way to try and go about it, but Now you know a little bit, yeah, Paul Harvey, now you know the rest of the story. Now you know a little bit about how commercial policies work. Guys, if you end up selling commercial, it may look nothing like this, okay? But this is how the test wanted me to prepare you. This is what you're going to see on the exam, all right? All right, so we've been going at it for a while now, so what I would probably suggest is taking a 5-minute break before you take this next test. If you want to take it right now, you can, but I can tell a lot of you are getting antsy, so here's what we're gonna do. We're gonna take 5 minutes, then we're gonna take this next test. That next test then should have you done by, let's say, 4:20. Yeah, that'd be right, about 4:20. So I'll say I'll be back in here at 4:25 then, okay? At 4:25, we're gonna go through this test one by one. I'm telling you right now, you're gonna have to break down these questions and think outside the box just a little bit, okay?